You know what makes absolutely no sense to me? People obsess over finding the perfect investment while ignoring the financial mess happening right in front of them. They'll spend hours researching stocks, watching market predictions, listening to random finance creators online. Meanwhile, they've got a credit card quietly charging 22% interest every month, like a subscription they forgot to cancel. That is not investing. That is trying to build wealth with a hole in your pocket. And the crazy part? Millions of people do this every day. They want the exciting shortcut, the fast money, the what should I buy right now answer. But wealth usually doesn't work like that. There's a sequence to this, an order. And if you get that order wrong, you can waste years making almost no real progress. Think about building a house. You don't start with expensive furniture. You don't pick marble countertops before the walls exist. You build the structure first. But financially, people do the exact opposite. They chase investments before building stability. And then they act surprised when one emergency destroys everything. So here's the smarter approach. Before investing heavily, before chasing returns, before trying to beat the market, you need protection. Because life has perfect timing. Your car breaks down, unexpected medical bill, phone dies, job loss, family emergency. Something always happens. And when it does, you need money that isn't attached to debt, panic, or selling investments at the worst possible moment. That's why the first move isn't exciting. It's an emergency fund. I know, not glamorous. Nobody dreams about a savings account. But this single step protects almost everything that comes after it. Because without emergency savings, every unexpected problem becomes expensive. Now, people always ask the same question. How much do I need? The classic answer is
6 months of expenses. And sure, that's a useful guideline, but your real number depends on your life. Stable income? Good job security? Maybe you need less. Freelancer? Unpredictable work? Commission income? You probably need more breathing room. But don't get stuck chasing the perfect target. Start smaller. Build your first emergency milestone, your first $1,000, then 1 month of expenses. Then keep climbing, because progress beats perfection every single time. And here's something interesting. Having emergency savings changes more than your bank balance. It changes your behavior. When you're financially cornered, you make rush decisions. You borrow money. You panic sell investments. You accept bad deals because you need immediate relief. But when you have a cash buffer, you think differently. You have options, and options are powerful. Once that foundation exists, now we deal with the real wealth killer, high interest debt. This is where a lot of people accidentally sabotage themselves. They invest money every month while carrying debt that grows faster than their investments. Think about how strange that is. You're hoping your investments return 8%, maybe 10% on a strong year, but your debt is charging 20%, 22%, sometimes more. That math is brutal. Eliminating high-interest debt can be one of the best financial moves you'll ever make, because unlike the market, the savings are guaranteed. No guessing, no predictions, no hoping. Credit card debt especially, that stuff compounds against you, quietly, aggressively. Minimum payments make it look manageable.
That's the trap. You feel like you're handling it, but interest keeps eating your future 1 month at a time. Money that could have been growing for you is now working for the credit card company instead. And look, not all debt is identical. A low-rate mortgage? Different conversation. Some student loans? Depends on the rate. But expensive consumer debt? That needs attention. Fast. Because investing while drowning in high-interest debt is like running uphill carrying a backpack full of bricks. You can move, but you're making life much harder than it needs to be.
Now here's where things start getting interesting. Because once expensive debt is handled, we reach something people ignore constantly. Free money. Actual free money. And somehow, people still leave it behind. If your employer offers a retirement match, you need to understand how powerful that really is. Imagine somebody walks up to you and says, "Every dollar you contribute, I'll add more money." Most people would accept instantly. But financially, people skip it every year. Which is wild, because employer matching isn't complicated investing magic. It's a guaranteed return. If your company matches contributions up to a certain percentage, that should immediately get your attention. Why? Because very few investments guarantee anything. Markets move, stocks fall, predictions fail, but matching contributions, that's real money being added to your account. And ignoring it is basically turning down part of your compensation. After that, tax-advantaged investing becomes your best friend. This is the part many people underestimate, because investing isn't only about returns. Taxes matter. A lot. Keeping more of your gains matters. And accounts like IRAs exist for exactly that reason. They give your money room to grow more efficiently. Less tax drag. More compounding power. Over long periods of time, that difference can become massive. Most people underestimate what time plus taxes can do. Tiny advantages repeated for decades become huge advantages. That's how wealth quietly builds. Not through constant excitement, not through daily trading, usually through consistency, good systems, and avoiding preventable mistakes. Now, there's another account that almost nobody talks about enough. And honestly, it might be one of the most underrated financial tools available. The HSA, Health Savings Account. If you're eligible for one, pay attention, because this account has something rare. Triple tax advantages. Money goes in with tax benefits. Investments grow with tax advantages. Qualified medical withdrawals can come out tax-free. That combination is powerful. And here's where strategy matters. If you can afford it, many people choose to pay current medical costs from normal cash flow and allow their HSA investments to stay invested, growing, compounding, working quietly in the background. Medical expenses don't disappear in retirement. If anything, they usually increase. So building dedicated resources for future healthcare costs can become incredibly valuable. And once those tax-advantaged buckets are fully working for you, then you continue maximizing retirement contributions. Because this stage is where compounding really starts flexing its muscles. Your money earns returns. Then those returns earn returns. Then those returns produce more returns. Year after year. Quietly. Relentlessly. This is why starting earlier matters so much. Not because you need perfect timing. Because time itself does heavy lifting. And here's something people don't like hearing. Most investors don't fail because they chose the wrong ETF. They fail because they never built a system strong enough to stay consistent. They chase trends, change strategies every 6 months, jump between hype cycles, and confuse activity with progress.
But once you've built emergency savings, eliminated destructive debt, captured employer matching, used tax-advantaged accounts, maximized retirement opportunities, then finally, we arrive at the place most people wanted to start from. Taxable investing. The investing playground. Unlimited flexibility. No contribution caps. More choices. More freedom. And honestly, more opportunities to make expensive mistakes. Because when people enter taxable accounts, they suddenly feel unstoppable. Individual stocks, options, crypto, leveraged bets, speculation disguised as confidence. And sometimes, things go badly. Fast. Now, taxable accounts absolutely have value. They're flexible. Need funds before traditional retirement age? Useful. Building wealth beyond retirement accounts? Useful. Planning long-term financial flexibility? Very useful. But taxes matter here. Dividends, capital gains, selling winners. The government usually wants a share, which means efficiency matters, strategy matters, account placement matters. Over decades, small tax differences can create enormous outcome differences. That's why order matters so much. Not because investing has to be complicated, because sequence changes results. Emergency fund. Destroy expensive debt. Capture employer match. Use tax advantages intelligently. Build retirement strength. Then expand into broader investing. Simple, logical, powerful, and honestly, not flashy, which is probably why so many people ignore it. Because boring systems rarely go viral, but boring systems often build wealth. And chasing excitement usually costs more than people realize. Your future self doesn't care whether investing felt exciting. Your future self cares whether the system actually worked. So before asking what stock to buy next, ask a different question. Have you built the foundation strong enough to support real wealth? Because once the order is correct, everything else gets easier.